My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be my friends. I'm just trying to save you a little money. My job is not to entertain, but to educate, teach, explain why days like today happen. Call me at 1-800-743-CNBC. Tweet me, Jim Cramer. The newfound rationality continues. This market's punishing the weak while rewarding the strong. It's no longer making excuses for poor performance. In some cases, it's not even embracing good performance after the monster move we've had in the last 2 weeks. That's why on the eve of the big Federal Reserve powwow in Jackson Hole, the averages got slammed. The Dow sinking 170 points, S&P down 0.43%, NASDAQ tumbling 1.67%. It's back to reality, and reality can sting. If you recall, in the wake of the bizarre unwind of that yen carry trade, the market had a quick collapse and then a remarkable 8-day resurrection that buoyed pretty much everything. Anything that's good exploded higher, and we figured anything bad was going to get good once the Fed started cutting rates. But that was then. This is now. Since the winning streak ended, we're starting to get into what I call the buyer's remorse phase of this move. Stocks that had a nice run based on nothing more than hope are now rolling over hard. And not even the knowledge that the Fed cavalry could be coming is enough to save them. Perhaps the selling's exaggerated because tomorrow's the Fed they speak in Jackson Hole, and Wall Street's already baked in the possibility of September rate cut. Can't get any better than that. Maybe the bulls think we need some sort of impossible statement, like Jay Powell promising multiple rate cuts. Not going to happen. Maybe the Fed's already too late and the economy will get real ugly. Or maybe traders are beginning to fear the possibility of a Democratic sweep in November, which could lead to higher corporate tax rate, bad for earnings, and a potential witch hunt for price gouging in the aisles of the supermarket and the drugstores. I got to tell you, I don't believe in the first two explanations. Not everything gets saved by the Fed because many companies simply aren't that sensitive to the economy. Second, it is never too late for a rate cut, for heaven's sake. The turn gets delayed but not canceled, except for the companies with terrible balance sheets. The latter actually deserve to go down and even stay down if they've loaded themselves up with debt and have to start paying it back in a couple of years. But the third, politics, getting tricky. Coming into this week, I think most investors believed that President Biden was no friend of the stock market. He's pro-labor, he's not pro-capital, and I can count on two hands the number of executives that he regularly is in touch with. Biden seems tone-deaf to most execs. Vice President Harris, coming out of California, the home of so many tech businesses, and with friends from business, including her very close brother-in-law, Tony West, general counsel of Uber, was perceived to be friendlier to commerce. However, this week's convention's got a lot of investors now buzzing about how a Harris presidency might be even more antagonistic to business than the Biden administration. We know there's heavy emphasis on bashing the food and the drug companies for raising prices, even as the Biden administration put through the first real attempt to have our government control the prices of some very heavily used drugs. We also know that any Harris initiative to stop price gouging will most likely be ill-fated. We need the retailers with scale to jawbone prices back down. And for the most part, Walmart and Costco have done exactly that. They've done a terrific job of reining in the suppliers and urging them to take price back down to post-COVID levels. But on the campaign trail, Harris has no incentive to acknowledge that there are a couple of good actors and bad actors. It's much easier just to use a broad brush, bash big business for collectively taking advantage of the pandemic to raise prices. They can't come down without the help of the government. That's the wrap. These factors can all explain some of today's weakness, but honestly, what I'm most concerned about is the prediction we got over this week from Larry Williams, the incredible market prognosticator and historian. I trust Larry, and I don't like going against him. Larry sent us his thoughts on Monday, and he used a term that made me concerned. He said that the rally was kaput. Mind you, this was on the 8th day. The word kaput has some ominous connotations, right? Especially because we didn't take out the highs of the averages despite the 8-day win streak. Worse, Larry's charts showed tough sledding for the S&P 500 next week, led by the most important stock in the entire market. Maybe the most important stock I've ever seen, NVIDIA. Given that the market's overbought, +5 on the S&P short-range oscillator that I follow, the idea that the rally's kaput has some resonance. Doesn't help that NVIDIA's run up rapidly into the quarter, and the expectations have gotten out of hand. The stock did a horrible reversal today. Just painful to watch. So what's taking on the chin here that might have just been grazed in a more generous market? I want to give you some examples to tell you how tough this market has gotten, even versus a week ago. Why don't we start with last night's guest? Let's start with Snowflake. That's the data storage and analytics company. Snowflake beat the numbers. That raises forecast. If you listen to the interview, you might have thought the stock would be up big. But But if you were a bear, you'd say Snowflake has to spend a great deal of money to ensure that its customers can store data in the cloud and then also put it to work, prosecuting the data. And that's what competitor Databricks is doing. So that's what maybe Snowflake's got to do that too. They're in a dogfight that they might be losing. And that's why margins are down so much, and that's what people looked at. The glass half empty thesis rocked the stock today, sending it down nearly 15%. Seemed excessive to me, but who am I? Or how about Williams-Sonoma, which delivered solid numbers, but then got beaten up, down more than 9%. Why? Furnishings. Oh, man, that's a tough business for anyone in it with rates higher. Listen to what CEO Laura Alper, who's really great, had to say, quote, there is no doubt that the home furnishings market is challenged due to the uncertainty in the economy, coupled with slow housing. This leads us to believe that we may not see the back half of acceleration that we expected, despite all the hard work we have done to improve our product offer and our customer experience. Ouch. During the glorious 8-day run, we would have just said that Alper was being cautious, and Fed's going to save the day when it starts cutting. Ignore her forecast shade down. Just think about the positives. Not today, though. Today, Wall Street was rational, and the stock got hurt bad. How about BJ's Wholesale Club? In an era of escalating prices, BJ's worked hard to keep a lid on the customer's costs. CEO Robert Eddy pointed out that the company has, and I quote, invested considerably in order to make our members make their baskets work within the confines of their budgets. Hey, pretty good, right? He said that's part of the company's DNA. But then he adds, these investments may pressure our short-term results. Oh, no. During those fabulous 8 days, we would have ignored that phrase entirely. People would have been focused on how terrific it is that BJ's is fighting inflation. That era is almost over. Now, instead, all we think is cutting numbers BJ's, and the stock gets pulverized, falling nearly 7%. The bottom line, my hope is that we're somewhere between Larry Williams' kaput analysis and the days when everything goes up, both good and bad. No matter what, the market's still too overbought, and we got too hopeful, and now reality, with its positives that get rewarded still, and its negatives that are punished, has set in. So the time for big gains may be behind us for a bit as we recharge and shed our Panglossian rose-colored glasses. Let's take some calls. Let's go to Mark in Wisconsin. Mark.
Dr. Cramer, thank you for taking my call.
My pleasure. What's up?
I got a merger for you in the healthcare REIT sector. The company we owned in our IRA, Physicians Realty Trust, was taken out in an all-stock merger by Health Peak Properties, ticker DOC. What say the good doctor? Buy, sell, hold?
Okay, look, people are going to be really interested in getting yield, and that is a very high-yielding REIT that's done quite well. So I'm going to have to say I endorse it. That said, look, it's at its high. It's like realty income. Let's say you call me realty income. That's at its high. A lot of the ones that yielded 6 are now yielding 5, and they come to play. I think yours is one of them. Let's go to Eddie in Texas. Eddie.
Good evening, Jim. Thank you so much for having me online and for all the great work you do for all of us, helping us get rich. My question is regarding Starbucks. With the recent CEO change, is Starbucks a buy heading into 2025?
Yes, the answer is Starbucks is a buy. Look, you got to be a little more patient. Brian Niccol, who's come from Chipotle, is fabulous. Will it go straight back to 100? No. Will it go from 92, 88? No, it's never going to be the same because Brian Niccol is that fabulous. CEOs matter. We tend to treat them as if they're all the same. They're not. Niccol's the real deal. I like what he's going to do. Nathan in Texas. Nathan.
Hello, Jim Cramer. I got one question about Carvana.
Sure. All right. Go ahead.
I noticed that it's at a high price. Should I hold my shares or should I sell?
Okay, today it had what's known as a bad island reversal, went all the way up and then came back down. Now, I'll tell you this. Ernie Garcia is kind of an unstoppable force, and as rates go lower, he will do even better. Do not buy this stock right here at 153. Let it come in. It's been hanging here for a couple of weeks. If you can get this stock in the 140s, I would start picking some up. Hey, let's go to Ann in Indiana, please. Ann.
I'm a club member. Thank you for everything. I wish I sounded as smart as Dave in Illinois, but this Abbott thing, or Are we just like monitoring this since Lily?
Okay, I got the whole lawsuit thing down. We got one more lawsuit that's done in September. It's going to be in the same jurisdiction as the bad one where they got the very big verdict. I think that verdict's going to be brought down. I think they'll lose the next ones too. But we're holding on to it for the trust. Why? Because Abbott's a great company. In the end, these are product liability suits. They are not mass tort action like J&J. And I think we'll come out ahead of the game. They've got 4 great product lines that are selling fabulously. The market is still too overbought, people. We got too hopeful. So now we might need to take a brief respite. There's nothing wrong with that. Maybe a little buyer's remorse, throw that into Mad Money tonight. How is Gen AI shaping the fintech space? I'm checking in with the maker of TurboTax and QuickBooks after earnings to see how much credit we should be giving them in the latest quarter. You know how good they are. Then cruise line Viking has been sailing higher since its IPO, but it pulled back on today's report. I'm going to talk with the company's captain, learn more about what's going on. And how could a rate shakeup affect Fortune Brands in its line of home products, which are at the highest end? I'm sitting down with the CEO to get a better read on how the company's doing. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.